Morning, everybody. Welcome to this session of Business Bitesize. And I thought I'd touch on cash flow and financing this week, having quite a few conversations with a number of different clients about that, preparing a number of cash flow forecasts, looking at different scenarios depending on how the business grows. Give us a few alternatives in terms of performance over the next 12 months or so. And that throws up some issues around financing. If we're growing, how we're going to fund the increasing working capital or additional machinery or capacity that we need to bring in. And nowadays, of course, we're not restricted to high street banks or the business bankers anymore by any stretch of the imagination. So one of the funding platforms we use has access to over 120 lenders, including the 4 high street banks. So there's a lot of choice, and of course products and finance has become an awful lot more flexible compared to how it used to be. Long gone are the days of loan, overdraft or invoice finances. Many more flexible products than that on the market, and lots of providers looking to work with SMEs. So always good to look for alternatives to the norm, and certainly able to help with that. Moving beyond that, though, I think it's interesting just to reflect on what any finance provider is looking for. And despite the market becoming much more flexible, I think the 3 kind of fundamental things you need in place are still really the same. First one I would say is serviceability. So lenders are going to want to see that you can generate the cash flow going forward to repay the loan, and that still tends to be done on a historic basis. So speculative lending based on a forecast, buying a new piece of kit or a factory or doing something else, it's going to generate lots of new income going forward, but that's not, there's no history of that. It's always going to be challenging. I think a good solid performance historically, which generates cash and sufficient cash to service the loan or the borrowing, the finance, is fundamentally important. I think against that we have to reflect to current circumstances with the pandemic measures, the lockdowns, etc., and the government support. So lenders are looking to see that the business was viable at some point in the last couple of years, and actually reflecting and acknowledging that the numbers for the last couple of years might look quite different because of all those things that went on. But there does need to be some demonstration of solid historic performance somewhere that's going to generate the cash. So that's serviceability. The next one that gets talked about a lot is security. So currently the government are putting up security for various loans to support businesses, but actually the government have always had facilities in place to offer 2 guarantees to support loans for businesses that are looking to grow. So it's not something necessarily new, but it's certainly something I think a bit more wide-ranging than we've had before. Those schemes are starting to unwind, but I'm sure they'll be replaced by something else. But security is an interesting one. So people get quite nervous about the security side in terms of putting up their houses, which is very understandable. And I think it comes down to a simple equation. If there's no security for the lender to fall back on, a plan B to get their money back, then the risk goes up and therefore the cost goes up, so the interest rate will be higher. So I think in my head it's a simple equation really. You either pay more interest, or the business does, or you're prepared to put up security of your own personal assets. So that's the equation there. And I think the final one is still the skin in the game. So I think the financiers won't want to see that they're having to fund everything 100%. I think they'll want some commitment from you, because I think that generally is exactly that. It gets some commitment, so you don't disappear over the hill out of sight if it all goes wrong and they're struggling to get their money back. So they need some commitment, some demonstration of a commitment from you as well. So I think those are 3 core things to think about. But as I said, there's a lot of competition out there. The reality is that money sat in bank accounts earning 0.5% interest or less. So actually lending it in sensible circumstances with the right risk profiles, with a return of anything over 5 to 10, 15%, is clearly going to be attractive. So this is why I think we've got lots of new finance businesses, providers in the market, looking for SMEs that need the support to help them grow and develop. So it's definitely worth exploring outside of the traditional banks if you're looking to raise funds, and very, very happy to help with that. Thank you for listening. See you next time.